What's the definition of a current liability? Debt due within a year. And what do we mean by debt?
Financial obligation.
So like an unearned revenue would be a debt? What do you think?
Yeah.
Think it would be?
They paid in advance because of the service.
Right. But is that a financial obligation?
You have to pay them back.
Well, no, you could perform the
You
service,
pay the service or pay them back.
right? So I think calling it a debt or a financial obligation may be too limiting. I think it's something you owe in some form or other that should be paid back within the course of a year. So I can't argue with that. So what would a long-term debt be?
10-year loan.
Or the cycle.
Yeah, I leave out the cycle though, because that can get confusing. I mean, all textbooks will say 1 year or the accounting cycle. What's a typical accounting cycle? Well, for something that runs across 4 seasons, it would be a year. Seasonal. And maybe you could, if you're not saying something, maybe mute your microphones at home. But some things, if you're building a nuclear submarine or aircraft carrier, what would be the cycle for that?
10 years.
Years, 5 years, 7 years, 10 years. So you can't do financial statements for 5 years, or you can, but that determines what's current and non-current. So I just like to use a year, not get caught up in that. Mostly because I've also never seen it. I think if we just use a year, we'll be okay. So suppose we have something like a car loan that runs for 3 years or 4 years. Is that current or non-current?
Part of it,
Part of it,
the part of it that's due during the year end.
so it's both. There's a component of it that'll be paid within the next year. That piece is current. The balance won't be paid during the next year. That's non-current. So we would separate it into 2 pieces. The piece that's going to be paid next year, we call current portion of long-term debt. Notes payable can be current. How do we know if something is a note, a bond, or a loan? How do we differentiate and know when to record something as a note, when to record it as a bond, and when to record it as a loan? You go to the bank, you borrow $100,000, 8%, 3 years. Do you record loan payable, note payable, or bond payable?
Loan payable.
No.
How many people said no? Why no?
Because we have a formal agreement.
Could a loan be a formal agreement?
Not always.
Well, it's not always, it's can it be? Can a bond be a formal agreement? Is a bond usually a formal agreement? Usually it is. Very seldom would you have an informal bond arrangement. So why can't it be a loan? When you go to the bank and you take the money, do you usually come home and say, I just took out a note, or do you say I usually took out a loan? Is your If you have a loan for a car, is it a bond, a loan, or a note? Many people say loan. Generally, it's a note. The only way to really tell is to look on the piece of paper and see what it says at the top. If it says loan agreement, you call it loan. If it says note agreement, you call it a note. And it's really the only differentiation. Some of these have features that are more typical in one type than others. But almost anything could be any type, and you really don't know until you look at the paperwork you sign. A lot of banks make loans. A lot of banks secure the loans with notes. Sometimes they do, sometimes they don't. Sometimes the paper they secure it with, they call a loan agreement. So it's just semantics to just make sure the paperwork accords with how the accounting is done. It's the features that really matter to us. It doesn't matter what we call it. So if we borrow $100,000, let's say January 1st, 2015, and interest is payable annually on 12/31/15, how much interest are we going to pay on December of 15?
8,000.
How many?
8,000.
8,000, right? 8% times 100,000 is 8,000. So that's what we'll pay December 31st. The general formula is the face amount times the rate times the percentage of the year the loan is outstanding. So if we borrowed this money on 7/1 and interest is payable December 31st, how much interest would we owe?
4%. 4%.
4%, but 4,000.
Right.
December 31st, we would owe half a year. So it would be 100,000 times 8% times 1/2. So if it's 100,000, 8%, 5 years, you take it out January 1st, 2015, it's paid quarterly, March 31st, June 30, September 30, December 31st. How much interest do we owe each quarter?
2%.
2,000.
Yeah.
Right. So we don't get fooled by how long the life is. That doesn't affect the interest that's paid. It just affects how long the loan is outstanding. So to record the note, we would debit cash, credit, note payable, loan payable, bond payable, whatever it is. Then each time we made an interest payment, we would debit interest expense. Let's say it was quarterly, credit cash. So let's take, we took out a $10,000 loan, 12%, 3 years. Interest is due on the 1st. So it'd be due next year on the 1st, the year after that, the year after that. It matures 1/1/18, so the principal and interest will be due on 1/1/18. The first entry we make is 1/1/15. Debit cash. Credit loans payable. When's the next time we have to make an entry?
The same day, with the interest.
The same day?
The 31st of
December.
December.
December 31st?
Yeah.
Okay. And what do we record on December 31st?
Interest expense,
Interest expense, how much?
1,200.
And what do we credit?
Cash.
Interest payable.
Interest payable. Because the interest isn't due until January 1st. That's the payment, but the expense should be in 2015. So we're going to accrue it. We're going to record the expense and the payable at 12/31/15. Then 1/1/16 will debit interest payable. And credit cash. Now that's what we teach in accounting. How many people think it really happens like that? When's the interest payment due? On the 1st. How many people pay monthly rent? When's the rent due?
The middle. For me, it's the
Beginning of
The middle of the month?
Yes.
the beginning.
Beginning of the month. More typically, most people would say January, the 1st of the month. So you wait until January 1st to make your rent due, that's due January 1st?
Yes.
You do? How does that, are you always late or do you hand it to the
They
landlord?
gave me like 5 days so to make the payment. So from January 1st to January 5th.
So
After
you-
that, they charged me $150 for late.
And you ever paid a late fee? You ever get a late fee?
No, never. No.
But you're always within that grace period. Yeah. How many people, if they owed rent on the 1st, would probably write the check out a couple of days before? Now, would you do that? Would you credit cash or would you credit rent payable and wait for the 1st?
Rent payable.
You really would?
No.
I didn't think so, Brett. And we would probably just record, we write it out on the 29th, we mail it, we would probably credit cash at that point. But technically, debit interest expense, credit interest payable, and on the 1st, debit interest payable, credit cash. And we would do that each year, and then the last year, we would also debit loan payable, 10,000, credit cash, 10,000 to pay it off. Suppose, let's change it a little bit. Interest is due at maturity. So same terms, except we don't make annual payments of interest. We don't pay the interest until it comes due on January 1st, 2018. And how much interest will they collect in full at that time? 3,600. So on 1/1/18, with this new scenario, what will the entry be?
Debit interest payable, 36.
Debit interest payable, 36.
And then loan payable, the remainder, 10,000. And then credit, 13,600.
So each of the years, even though there's no interest going to be paid until maturity, we still need to record the expense. So at 12/31/15, we would make this entry. We wouldn't make this one because we're not paying it on January 1st of the next year. 12/31/16, we would make this entry again, so that 2016 has its interest. And we make this entry again at 12/31/17. So by the time January 1st, 2018 comes around, all the interest has been accrued. So we just have to reverse the interest payable. We just have to write that off. Take out the loan payable and credit cash for 13/6. Any credits, any questions about loans, notes, or interest? We have payroll-related current liabilities. How many people have a job? A lot of people. So let's say your weekly salary is $10,000. So at the end of the week, you get a payroll check for $10,000, right? How many people would agree with that? How much of that 10,000 do you get? It's not a real specific number that we would all agree on. It's probably going to be a range, but if you made 10,000 a week, would you be surprised if you only get a check for 6,000?
No.
No. Would you be surprised if you got a check for 9,500?
Yes.
Yes. So we're going to say we're not surprised on getting small numbers. We're surprised about getting big numbers. So what happens to that $10,000? Taxes. When we say taxes, what do we mean?
Social Security.
Federal.
Okay, Social Security. Social Security is 6.2%. Medicare is 1.45%. Together it's 7.65. That's required. You don't get a say about that. There is some good news. At this weekly rate of pay, after a couple of months, the 6.2 stops. There's a maximum salary before they stop taking it during the calendar year. No maximum on the 1.45%. What else is going to be withheld? Well, we have federal income tax withholding. We have, in our case, New York State income tax withholding. If you're lucky enough to work in Manhattan, well, the boroughs, you have New York City income tax withholding. Now, these are voluntary. It means we decide as employees how much we want withheld for each of this. And there's a form you can fill out, and it'll help you estimate if you want to get as close as you can to having withheld what you're going to owe. You can estimate it. But you may have factors in your life that don't show up on the withholding table, so you can adjust it. How many people are married? Okay. So even though you're married, can you be withhold single as a single? Yeah, and if you're single, could you fill out on the form withhold it married? How many people single, no children? Can you have them withhold for 10 exemptions? Like you have 10 dependents? Yeah, you can. Yeah, it's not factual. All that does is it's a way to adjust the withholding so you have withheld what you want. So you don't have to be truthful and say, I'm single, I don't have kids, I must be single 0. You could do married 10 if you want. It doesn't say how you're going to file your taxes. It's just a way to adjust the withholding to get it to the level you want. The other way to do it is to say, look, I'm single 0. I want more withheld. can't really do anything from this point, so just add $100 to whatever the calculation says. You could do that also. So I get, one of the places I used to do the accounting for, they had a lot of married 16, even though they were single zeros. So they don't want anything withheld. Well, the minimum one. You could do that. And then at the end of the year, you file your taxes. If you didn't have enough withheld, not only do you have to pay it, you'll also have interest. Some people view it as a savings bank. They want to over withhold, so at the end of the year, they get a refund. It's also legit. In addition, we have other voluntary withholdings. You might share in the cost of health insurance. That'll be a withholding. You might have union dues withheld. You could have contributions withheld. You're an Iona, you could have them withhold for a contribution to any of the different fundraising plans they have. Or in some places, they'll withhold for United Way or other charities. You could have them withhold to pay into a 401k, 403b, or a pension plan. And they might withhold for disability. It's anybody ever see like a deduction for like $1.30 or something like that on their check? If you do that, they're offsetting the cost of disability insurance. They're allowed to do that. So these are all choices you make as employees. If they do this, you don't get a say. You don't get a say in that. There are some people that are exempt from Social Security and Medicare, but most of us are not. And most of us can't adjust how much is withheld. If you have two jobs, each job will separately withhold. And let's just say this isn't the right number. Well, let's say Social Security stops when your annual salary accumulates $115,000. So let's say I have two jobs that each pay me $500,000. Each of these limitations is calculated separately. So if I only had one job, it would stop at 115. Each of the two jobs I have is going to stop at 115. So I'm really going to pay in double what I should. At the end of the year on my taxes, I get to use that to offset my federal tax liability or get a refund. It's not lost money.
Is there a number? Is there actually a number where it stops?
Yes, there actually is. I just don't remember. You want to know it for sure?
I was just wondering.
Yeah, there absolutely is. It's not an even number.
I mean, I can look it up.
Yeah, we could all Google it. Yeah. Well, the 1.45% doesn't stop that. So if we make $100,000, the entry to record the payroll would be debit salary expense, $10,000. Credit Social Security payable, 6.2% of that. Credit Medicare payable for 1.45% of that. Credit federal income tax withholding for whatever the employee selected. Let's say it's $1,000. And let's say New York income tax is $500. And since we're in New Rochelle, there's no New York City. So we'll skip that. And let's say they don't have any of these other things. So the credit to cash, the amount of their check, is going to be what's left. So that looks to be 1,500, 1,645, 1,665, 2,265, 77.35, if my math is right. So that would be the amount the employee actually gets. Now, we're not quite finished with this employee yet. That's all you're going to see. But as the employer, there's also other things the employer has to pay. The employer has to match this. So they're going to record Social Security expense, Social Security payable, Medicare expense, Medicare payable. There's also an acronym called FICA, F-I-C-A. All FICA means is the combination of Medicare and Social Security. So FICA is 7.65%. If we break it into two components, we get Social Security at 6.2, Medicare at 1.45. So we can record them together or separately. In addition, for-profits and some nonprofits pay unemployment insurance. There's FUTA, Federal Unemployment Tax, and SUI, State Unemployment Insurance. Both of those have their own rates. Nonprofits can choose to use what's known as pay-as-you-go. Pay-as-you-go means you don't have to pay anything unless someone's eligible for unemployment, then you reimburse their actual unemployment payments. So when it comes time to make the deposit to the federal government, the federal government's going to get this, 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 and this. It'll be an electronic payment along with a form that's filed. The form is filed quarterly. It's the 941 form. New York State also gets their own form. It's
New York State 45. NYS 45.
And what goes with the 45?
New York State, New York City wages.
And the New York State 45 ATK. So New York State gets the form that tells them how much you're paying along with how much everybody made. So whenever we accrue salaries, we accrue these items. So at the end of a period, if we're accruing salaries payable, we accrue the taxes that we'll owe on it. We make a payment, we'll debit the payables, we'll credit cash, and it should wipe them out. Any questions about payroll related stuff? You feel better knowing where your money's going?
No, not exactly.
No.
Sales tax. Who enjoys sales tax? What's the current sales tax rate in Westchester?
It's 8.875 in New York City.
That's the city, not Westchester. Way to go.
All right. That's correct. But let's just use 8%. So if you buy something and the total cost with tax is $100, how much was the item and how much was the sales tax?
92 for the item. 92 for the item.
92 for the item, and then $8 for the sales tax. Okay, so we could test this, right? Because if we take the item price and times it by 8%, what do we get? Well, no, just times the 8% won't give us 100. 736. So if that's 736 plus the 92, we should get the 100, right? But we don't. Why? Because $8 is 8% of 100. Sales tax is 8% of the item cost. So what we need to do is take the item cost, or we have to take the total cost, and divide it by 1 plus the sales tax rate. So if we take 100 and divide by 1.08, what do we get? $92.59. Now if we take 92.59 times 8%, what do we get?
Yeah.
7.41. Now if we add that to 92.59, we get back to the $100 we paid. So if the total is for the item and the sales tax, you divide by 1 plus the sales tax rate to get the item piece. So the entry would be cash 100, sales 92.59, sales tax payable 741. If you know the item cost $100, then it's easy. How much is the sales tax on an item that cost $100? 8. So we're going to collect 108, revenue's 100, sales tax payable is 8. It's only when it's combined we have to divide by 1 plus the sales tax rate. Sales tax returns are done quarterly. Anybody know what the quarters are? Yeah, it's every 3 months, but which of the month ends? March 31st? Not for sales tax. Sales tax, 2/28, 5/31, 8/31, 11/30. It's a month different than the quarters we think of: March 31st, June 30, September 30, 12/31. Now, sales tax, like those federal taxes on payroll, even though we do returns quarterly, we may have to make deposits more frequently. Depending on the amount of the liability, the money you're holding, you may have to make the deposits monthly, bi-monthly, weekly, or within 3 days. Even though you're going to file quarterly, your liability has to be paid sooner than that. If sales tax is small and incidental, you can pay it quarterly when you file your return. Any questions about sales tax? Unearned revenues, we've talked about before, we'll talk about them again. How does unearned revenues arise?
Prepaid.
Prepaid. Someone pays you for goods or services you have to deliver in the future. We debit cash. And we credit unearned revenue. When we provide the goods or services, we debit unearned revenue.
Credit revenue.
And we credit revenue.
Can you say that again, the last one?
When we provide the goods and services that we've been paid for, we debit unearned revenue and we record it as revenue. Anybody want to go over unearned revenues again? Or do you think you got it? Contingent liabilities. What does the term contingent liabilities mean? It means something that may or may not be a liability depending on the occurrence of a future event. Like a lawsuit. You're getting sued. Is that a liability? Well, you don't know until the suit is settled or adjudicated. So we need a framework for deciding whether we have to record it or disclose it. So we use 3 narrative terms of likelihood of negative outcome. It's probable, it's reasonably possible, or it's remote. And then we try to see if we can estimate the range of loss. Whether that range is reasonably estimated, not reasonably estimated, so if in the event of loss, it's probable we're going to lose, and we can reasonably estimate the range, we accrue it. Meaning we make a journal entry. If we can't reasonably estimate it, we disclose it. Reasonably possible, we disclose. And if it's remote, we don't have to do anything. So let's say we're talking about something that is probable we're going to lose, and then the range can be reasonably estimated. And let's say that range is 1 million to 2 million. So it's probable, so we have to record it. We'll debit an expense or a loss, and we'll credit a payable. How much? We can't record a range, we can only record a number. If the range is from 1 million to 2 million, That 2 million?
You always prepare the worst, so you hire the two.
The 2 million. Any other thoughts?
1.5.
Average? Well, accounting, we have the principle of conservatism. And what would conservatism say? Conservatism would say 2 million.
Worst case scenario.
But in this case, it's wrong. In this case, for some reason, we use the low end of the range. I guess because the concept is still not a definite. Probable doesn't mean definite. So you can take the benefit of the low end of the range. You can certainly do more. Nothing will stop you from booking the higher, but the rule says you should book the low end of the range. And if it turns out you're going to pay 2 million, you just have another million to record it then. Chances are most companies don't record anything. Why? Because if you ask their legal counsel, you're in this lawsuit, what's the likelihood of negative outcome? You're going to get back something that says, we're in the preliminary stages of the lawsuit and it's too soon to tell. And this is probably like 5 minutes before they settle. No matter what, unless it's done, they will not tell you anything about it. So you're going to wind up most likely disclosing. The other thing that you'll see a lot is you won't see anything in the footnote about it except to say that this is covered by insurance and it has no material effect on the financial statements. So not only don't they disclose much about it, they don't record it. But that's the theory behind what we do with contingent liability.
Wow, over the mountain, over the hill. Down on the road again.
Two last topics, and then we're done with this chapter. Warranties and premiums. Warranties are agreements when you buy a product that during a certain period it's not only cars, it's also TVs, radios, computers. That for a period of time, the company will fix anything that goes wrong with it within certain boundaries. Let's say you buy.
Bye-bye, Joshua.
You buy an item that costs $10,000.
Bye-bye.
Has a 2-year warranty. Warranty expenses are expected to be $1,000. So when you sell the item, you debit cash, $10,000, credit sales revenue, $10,000. Debit warranty expense $1,000. Credit liability for warranties $1,000. Year one, the end of the first year, the actual expenses for warranty repairs was $400. You would debit warranty liability, $400. Credit cash or accounts payable, $400. you would have already recorded the warranty expense, the expected warranty expense, at the point of sale. So all you would do is you pay for warranty repairs, is reduce the liability. Any questions about warranties? Premiums. Anybody ever see any premiums?
Amazon premium.
We're looking at the type like if you buy cake mix and you buy 10 boxes of cake mix and you send 10 box tops plus $1, you can get a mixing bowl. Anybody ever see anything like that? Or bubble gum? Anybody ever collect bubble gum? Bazooka Joe's? You get a certain number of those wrappers, you could send it in. Everything's electronic now. It's a little easier. I mean, Dunkin' Donuts, how many people have the Dunkin' Donuts app and pay with their phone? I got that. So you 200 points, you get a free coffee. But it keeps track for you. It's nothing like this. I mean, we're still teaching this, but it's kind of like, 500 years ago. Anybody's parents collect S&H green stamps? Used to go to the supermarket, and depending on the amount of groceries you bought, it would print out these stamps. They look like U.S. postage stamps, but you don't mail things with them. You take them home and you have this booklet, and you fill the pages with these stamps. And depending how many books and how many pages, you can get valuable things. I remember when I was a kid going with my mother, and she got me a basketball with the S&H green stamps. I remember going to the park, and all the older kids wanted me to play with them. Not because I was any good, because I had a new basketball. And that was immediate acceptance. And to give you the idea of how much class these guys had, they made sure I touched the ball just enough so I wouldn't decide it's not worth it to be there. So periodically I'd get the pass, and as soon as I got it, they wanted me to throw it back. But I got to stay there half a day with my new ball. The other thing I remember getting was a lunchbox. I always wanted a lunchbox as a kid, but I wanted the kind with the dome top. And I didn't get that. They didn't have that. I got this plaid, like tartan plaid, rectangular one, which was better than nothing, but barely. So we're going to make believe we're still in this world of premiums. So let's say 10 box tops plus $1 gets a mixing bowl. Each box of cake mix sells for $2.50. Mixing bowls cost 50 cents. And 60% of the box tops we sell, we expect to be redeemed. So let's say we buy 10,000 bowls and we sell 100,000 boxes of cake mix. And 15,000 box tops are redeemed. So we buy 10,000 bowls. How much does that cost us?
5,000.
5,000. So we'll debit our inventory of mixing bowls, 5,000. Credit cash, 5,000. We sell 100,000 boxes of cake mix. How much cash does that produce? 250,000. And what are we going to credit? Debit cash, credit.
Account payable.
Revenue. Debit cash, credit, revenue. Now we'll record our liability, our expected liability for premiums. What do we expect? So we're going to have premium expense and premium. How much is the liability for the premium we're expecting? So we sold how many boxes of cereal? 100,000. So that represents how many box tops? I'll give you a hint. Each box of cake mix has one top to it. 100,000. And how many of those tops are coming back, do we think? 60%. So 60,000. How many box tops does it take to get a mixing bowl?
10 bucks.
10. So how many bowls do we think we're going to send out? $2,000? No, 6,000. Right? So I'm just going to change one thing. 10 box tops plus 25 cents. How much are those mixing bowls going to cost us? If we send out 6,000, how much does it cost?
2,000. 2,000.
2,000? Well, 50 cents each, right? Times 50 is 3,000. But how much cash are we going to collect? If we do have to send out 6,000 bowls and they have to pay 25 cents for each one, we'll get $1,500. So the net cost is going to be $1,500. Boxes sold, percentage redeemed, expected. $60,000 box tops redeemed is expected. takes 10 per bowl. So 6,000 is the number of bowls. Cost per bowl. Total bowl cost. Cash collected. And then the net cost. So the net cost is going to be $1,500.
Sorry, what was the 1,500 cash collected?
25 cents.
25 cents per bowl times 6,000 bowls. So this would establish the liability when we record the sales. Then we reduce the liability by the actual amount that's redeemed. So we would take the 15,000 box tops, divide it by 10. We would send out 1,500 bowls. We would collect $375, and we would reduce our inventory and our liability for bowls. Does everybody see how the premiums work? Very important if we were in 1960. Quite as important today.
Complicated. Why is it so complicated?
Well, it's not complicated, it's just a lot of steps. There's a lot of numbers, a lot of pieces, and a lot of steps. It certainly seems more complicated than it is.
Is there a difference between warranty and guarantee?
Technically, there is no such thing as a guarantee. Because they can't guarantee it doesn't break. They can only fix it if it does. I remember this became a big issue about 30 years ago. They don't guarantee that it won't break. They just warranty it, meaning they'll be responsible for fixing it if it should.
Thank you.
More semantics than anything else. Anybody ever have anything that's never broke? Yeah. They came out with this iPhone case. Guaranteed, take it swimming, do whatever you want. Nothing can happen to it. Life proof.
They really do give you, they break all the time. They give you new ones.
Yeah, they give you a new phone.
The new case, like, just comes in, I'm like, oh, okay. But they never said, like, I don't think I really would take it in water because it's always.
I know people that dropped it in a little puddle and the phone got ruined.
Yes.
And they replaced the phone.
Oh, wow, I know, they just replaced the case.
Well, who cares about the case?
Well, mine always cracks, and it's never water. The seal's always.
Well, if it's cracked, it's not going to be waterproof.
Yeah,
So they can't
replace the whole phone.
they can't guarantee it doesn't break. They can only be responsible for the outcome if it should. But everything that's supposed to never break does.
I just read the handwriting. It's 10%, and that's for what per bowl?
The number per bowl. So the requirement is 10 box tops per bowl.
Oh,
So any questions about premiums? All right, let's do some homework. Sure.
You said after that, then 6,000 bowls are expected to send out, right?
Yes.
No, 6,000 bowls themselves, not 5,000. Okay, thank you. Because I was mixing bowls, said 5,000. That's just the money, not the number of bowls. you need to have the number of polls is 6,000. We paid 5,000 for all the polls that are in inventory.
Correct.
Okay, I just missed it.
Okay, so we had exercises 1, 2, 3, 5, and 7. Exercise 1, matching. Current liability, long-term liability, disclosure note only or not reported. Accounts payable. Current liability, current portion of long-term debt.
Current.
Current. Sales tax collected from customers.
Current.
Note payable due next year.
Current.
So,
Note payable due in 2 years. Long-term liability. Advance payments from customers. Current. Commercial paper. Most likely current. Unused line of credit. Well, the choices are current, long-term, disclosure note only, not reported. Why not reported? Why a disclosure note?
I don't know if that's what the answer was, and my guess is because you have to report that it's available to you. I didn't understand that part. That's
If someone's going to invest in the company, they need to know everything about it. Anybody who's using the financial statements needs to have a full concept of not only what's happened, but what's available to happen. So a company that has an unused line of credit hasn't borrowed at the time of the financial statements, but that access is always available. And maybe they're right on the cusp of ratios. They say, oh, this is like as far as I'm willing to go. The day after you invest or make a loan, they access that line of credit, which increases their assets and liabilities, but now puts them into a different ratio position. Now maybe it's not okay. So you need to know what's available to them as well as what they've already done. So that would be disclosure.
So in this case, we wouldn't record it, we wouldn't accrue it, but it's a potential liability. So therefore, it would go in, we disclose it in our basically our
Footnote.
asset debt ratio. So
You wouldn't add it to anything, but anybody who reads the footnotes, like our footnote at the foundation, says we have a line of credit in the amount of $20 million that has been unused for the year. So there's nothing in the financial numbers that change, but someone who wants to say, okay, let's say they do use it, what happens? Yeah, what's it then? The financial statements consist of balance sheet, income statement, statement of cash flows, and footnotes. The balance sheet isn't the financial statement, it's one piece of the financial statements.
Right. Which one would you?
The footnotes go be after all the statements. And it pertains to all the statements. We don't have the balance sheet footnotes, the income statement footnotes, statement of cash flows footnotes. It's one set of footnotes. Sure. A contingent liability with a probable likelihood of occurring within the next year can be estimated. Current liability. A contingent liability with a reasonably possible likelihood of occurring within the next year and can be estimated.
Disclosure.
Disclosure note only. The only one that gets recorded and shown as a liability is probable and reasonably estimated. Any questions on exercise 1?
No.
Exercise 2. On November 1st, 2018, Aviation Training borrows $60,000 cash from Community Savings and Loan. Aviation Training signs a 3-month, 7% note. Interest is payable at maturity. The year end is 12/31. So what's the entry to record the note on 1/1/18?
Debit cash for 60, credit note payable 60.
How do we know it's a note?
They say.
Because
Because
they
it's
say.
debit in there.
So we don't have to guess most of the time. Someone will tell us. What's the entry on 12/31/18? Debit interest expense. How much? 700. How do we get 700?
It's only 2 months. Oh, I'm sorry. I've got,
So it's going to be 60,000 times 7% times
1/6.
212 is 1/6. So 1/6 is 10. 10 times 7. 700? Might be, yeah. What do we credit?
Here.
What date does the note mature?
February.
The next day.
The next day?
See.
What day next year?
Okay, the next month. The next month. In the next month.
January 31st, 19. And what's the entry on 1/31/19?
Interest expense 350.
Interest expense 350.
I'm sorry. Payable 700. And then the other side is the 60.05.
Note payable 60. And then credit cash. $61.05. Any questions on exercise 2? E83. 8118, Trico Technologies borrows $21 million to expand operations. Loan is made by First Bank Corp. Under a short-term line of credit arrangement. Six-month, 9% promissory note. Interest is payable at maturity. Year end is 12/31. What's the entry on 8118? Cash 21 million. And what are we going to credit? Notes payable. Notes payable. What's the entry on 12/31/18? Interest expense, and what are we going to credit? Interest payable. And for how much? $2,520,000. Let's see. 21 million. 9%. Times
512.
5/12.
787,500.
787,500.
And interest payable 787,500.
787,500. How do we know it's 5 months?
The loan originates in August. It's 5 months accrual to December 31st.
My advice always is use your fingers.
Yeah.
It's the easiest way, and the easiest is to get confused between the first of the month and the 31st of the month. Something originates on the 31st of the month, you don't count that month. So in this case, it's the first, so we have August, September, October, November, December, 5 months.
What happens if the note starts on like the 15th? Would you take like 50%?
Ordinarily, in counting classes like this, they won't. But usually, you actually count the days.
You do.
Yeah, and a lot of agreements you have to read to know whether you use a 365-day year or a 360-day year. A lot of bank arrangements specify years are based on 360 days. So a mid-month, anything other than the first of the month, you would actually count the days. So how many days is 3 months? 90. Never.
90.
Right? It's almost never 90 days, right? You think of the contiguous 3 months. January is 31, February is 28, March is 31. That's 90, except for leap years. Then if you have February, March, and April, that's 89. If you have April, May, and June, and you go through it, very seldom is it exactly 90. A lot of times we say a 90-day note. It says a 90-day note. Do we mean a 90-day note or a 3-month note? Well, a lot of times we mean 3 months. So we're not going to get that specific here. We're going to kind of be reasonable people. A 3-month or a 90-day that starts on the first of the month will end the last day of 3 months later, even though technically it's probably not right. You really make yourself crazy with
So
this.
you do count August, right?
Because it's the first of the month, it's outstanding for the whole month. When does the note mature?
January 31st.
And what's the entry on January 31st?
Note payable 21, interest payable 787,500, interest expense 157,500, cash 21,945.
What was interest expense?
Interest expense was 157,500.
And credit cash?
21,945.
Any questions about 3? We had 5. Company provides cost-effective solutions for managing regulatory requirements and environmental needs specific to the airline industry. I always wonder why they spend so much time writing these problems. Would it matter to you whether or not they design and manage regulatory needs not cost-effective? They manage rather poorly. If they were a lousy business, if they did food, would any of that matter? Imagine how much shorter this would be if they took out all that unnecessary stuff. And how much time they spend naming these companies. OS Environmental. Assume that on July 1st, the company issues a 1-year note in the amount of $6 million. Interest is payable at maturity. Determine the amount of interest that should be recorded in a year-end adjusting entry under each of the following. So we have rate and year-end. 11%, 9%, 10%, 7%, 12/31, 9/30, 10/31, 1/31. Okay, so how much do we accrue under each of these scenarios? 11% with the year end of 12/31. How much is that going to be? I get 330,000 also. How do we get that? 11% times 6 million times half a year. How about 9%, 930?
135,000.
And how did you get that?
One sec. It's 9% times 6 million times 3/12.
So it's 1/4 of the year. It's outstanding for the month of 7, 8, and 9. So 3/12, so 1/4 times 6 million times 9%. About 10%, 1031.
200.
Let's see, 10% a year is 600,000. That's 50,000 a month, and it's outstanding for 4 months: 7, 8, 9, and 10. So 4 months times 50,000 is 200,000. How about 7% January 31st?
7% times 6 million times 712, 245,000.
So let's say 7% times 6 million is 420,000, which is what, 35,000 a month? 35 times 7 months is 245,000. I concur. Any questions about 5?
No.
Was 7 the last one? Aspen Ski Resorts has 100 employees, each working 40 hours a week and earning $20 an hour. They don't pay any health or retirement benefits. One of the perks is that employees are allowed free skiing on their days off. Federal income taxes are withheld at 15%, state at 5%, FICA 7.65% on the first 118.5. So there's a good estimate. For 2015, that's probably the number, 118.5. And 1.45% thereafter. Unemployment taxes are 6.2% of the first 7,000 earned per employee. Compute the total salary expense, the total withholdings from employee salaries, and the actual direct deposit of payroll for the first week of January. So 100 employees, 40 hours per week is 4,000 hours, and they make $20 an hour.
80,000.
So salary expense is 80,000. Do we credit cash for 80,000? No, because the employee is not going to get 80,000. What's 80,000 times 7.65%?
6120.
That's one withholding. $80,000 times 15%. 1,200.
Well, that.
So federal withholding is 12,000. State income tax withheld is 5% or 4,000.
Oh boy.
Anything else that comes out of the employee's salary?
That's it.
We're going to credit cash for the difference. So we have 20,120.
22.
22.
22,120. $57,880.
Yeah.
Okay. Then we have compute the total payroll tax expense. So this is to record the gross salary and the net salary. Now we have the employer portions. So FICA expense
6120.
is going to be the same 6,120. Looks like the only thing left is unemployment. How much is unemployment going to be?
4960.
So 6.2% times 80,000. And that's 4960?
Yes.
So this is a little easier because it's the first week in January. Because it's the first week in January, if the employee works 40 hours and makes $20 an hour, how much is their gross salary? $800. So we're not at the maximum of 7,000. Ordinarily, when we compute this tax, and there's a bunch of taxes, unemployment, there's workers' comp, there's disability, we have a variety of calculations we have to make. We have to look at how much they made per quarter and per year, because there's limits to when we stop taking out these, or we have to stop paying these taxes. Down here, the employee is not involved. It doesn't come out of their salary, it's just something the employer has to pay. This is fairly simple. And lastly, how should Aspen Ski Resorts account for the free skiing given to employees on their days off? They shouldn't do anything. How come?
Doesn't actually cost them. I mean, I guess if, they have a limit for how many people can ski at a given time and give space to their employees versus people to charge for, then they would charge, then they have to account for it. But otherwise, no.
Well, what does that cost them?
It costs them nothing.
Nothing.
Suppose someone who can't get on the mountain who would pay.
Yeah.
So what does it cost them in that case?
Revenues.
Cost them revenue.
Yeah.
Is that the same thing? Is not getting revenue the same thing as an expense?
No. It just doesn't mean you have as much money coming in.
Now, you probably don't remember when the rules around stock options were different. Used to be you give away stock options, the company didn't have to record any expense, because even if you gave away stock, what does it cost the company? Does stock produce revenue? No, you don't record revenue on the sale of your stock. Is it an expense? No. But let's turn this around. When you got stock from the company, did you get something of value? So should you pay tax on something you receive of value? Even if it didn't cost the company anything. How many people ever took a job just for the discount? I know a lot of people that work at Neiman Marcus, Nordstrom, Bloomingdale's, mostly not for the pay, but for the employee discount. Now, is that enough? Is that taxable income? No, probably not. So let's go back to this case. Days off, they get to ski for free. Do they get something of value? Should they be taxed on it?
Technically, when I was with the Mariners, used to get free tickets. And then the tax laws changed, they started paying tax on your tickets.
Right.
Which is ridiculous, because it's an intangible value. But since it was a value,
Well, it's not really intangible.
I mean, again, tax laws changed, so that's what it was, but it used to be free. So it cost them anything, it cost us anything. These have to start paying taxes, which I thought was ridiculous, but I get why.
But not everything is like that. Years ago, it used to be with my employee ID that entitled me to 16 free beverages a day. And it's gradually been changed over time. I still don't use it almost ever, but let's say I did avail myself of the 16 beverages. Did I get something of value?
Hammered.
It's coffee or soda.
Oh.
Yeah. I can hold my coffee. I did. Anytime I get something I would have to pay for, otherwise it's of value. The question is, do you have to pay tax on it? And the other side of that is, does the company have to record an expense? How many people get airline miles? How many people trade them in for tickets? You pay tax on that?
No.
The company. The company maybe.
No, it's not taxable. But did you get something of value?
Yes.
Should the company record an expense?
That seat it cost them. Well, it costs them revenue, it's not an expense.
And even still, it's very hard to know whether it cost them revenue or not. Most of the time, depending on how you book and your status, if they anticipate the plane being full, you won't get a seat.
Just block it out.
It's blocked out. But if they think they can afford it, they won't be turning away revenue. So it's not an easy issue. It's difficult. How many people say it should be an expense for the free skiing? How many people say it shouldn't be an expense? So most people hold no opinion on the matter. Suppose this was an exam question. Now, no opinion will cost you. Now, how many people say, yes, it's an expense?
What's the cost? In that case, it's the cost of doing business.
It's not an expense.
Not an expense. Why isn't it an expense? There's a phrase I'm looking for.
It's a fringe benefit.
Well, some fringe benefits are taxable. Now, we could look at it as for the benefit of the employer. So if you have a benefit that's for the benefit of the employer, like they provide you lodging so you can work 24 hours a day, or you get overnight lodging so you physically be present on night shifts. That's not taxable because it's for the employer's benefit. Is having employees on their day off skiing for the employer's benefit? You could try to make the argument it's like having an unpaid employee on the slopes should anything happen, spreading goodwill, keeping the place looking full and occupied. You could try to make that argument. For the most part, let's say that's not. The next level is called de minimis. It means it's of minimal value. Now, we know how much skiing costs, but for having employees utilize the mountain, become better acquainted with the facilities, you could argue most likely is de minimis. How many people do expense reports for where they work? They incur charges, they can get reimbursed if they submit a report. What number do you have to start submitting receipts for? Everything. A $3 coffee, you need a receipt.
Well, yeah, it's all done through a company card, so it's
It's all charged, so that's easy. So suppose you use your personal card. They don't take that card. You had to pay cash.
then it's up to me, if I want to claim it, if that's my problem.
But you would need a receipt for any amount.
I think of any amount, but if it's under 5, it's kind of forgiven and you write a ticket.
So $5 is. So a lot of places. You know what the IRS limit is? 75. Where I work, in addition to here, $50. Below $50, you don't need a receipt. Some places where you don't need a receipt, you have to do like an affidavit of no receipt. I incurred this expense. I don't have the receipt. I'm not required, but I did do it. We don't even need that. Less than 50, trust. And I know where they live. So any questions about chapter 8?
No.
We have a little bit of time. Does anybody want to go over anything from any of the other chapters?
I just have a question. Other than the homework problems, when I went back to try to remember what we did in class, where else should we look? questions, just other exercises or?
Yep, other exercises. They have brief exercises? How are they structured in this book? Yeah, they have brief exercises.
For the test, we should just do as many questions that will look like. That we can
Yeah.
understand the concept.
Exactly. You could even go the other way and look at some of the longer problems. Though a longer problem may not be a test question, there may be an element of it that does replicate a test question.
If we match it to like our homework problems, like how kind of in this chapter 2 and 3 were pretty similar. So like we should find something that makes kind of they were different the key steps.
Yeah. And see if they, maybe not exactly the same thing, but looking at an interest calculation maybe with a different narrative way of phrasing it. Any other questions? You want to stay here till 9:30 or you want to leave early? All right, so those that want to leave, feel free. Those that want to stay, I'm here.